Hello everyone, I'm Arvind Chari. I'm the Chief Investment Officer at Q India UK, which is an affiliate of Quantum Advisors Limited, Mumbai, which also acts is the sponsor of Quantum Mutual Fund. It's been good to speak to you again, and hope all of you had a very safe and a very healthy and a happy Diwali. And I'm assuming some of you would have recovered from the disappointment that followed in the World Cup final, where India lost to Australia in the Cricket World Cup. But how well India played over the entire tournament. I think India was by far the better team. You could see a lot of team, coming together and different players, different individuals performing at different times. But it's just so that we could not cross the final frontier, and that will always remain the disappointment. But nothing to take away from the excellent performance that the Indian cricket team put out. Uh, Subbu and Nilesh, who are the portfolio managers and headed the value equity strategy at Quantum Advisors, actually put out a note last month on both how the Indian cricket and how the Indian earnings cycle is on a high. Of course, these are always cliches, and you get a lot of these kind of things on on LinkedIn in terms of motivational aspects of cricket and markets, but it is really that. If you see how the Indian companies and corporate earnings and corporate revenues have grown, they've been consistent, and we are seeing a fairly reasonably good recovery into corporate earnings, corporate profitability. Uh, Revenues have been a bit lower than expected. There is some amount of slowdown that we see, but as the costs have come down, if you look at uh, all commodity prices, including oil and other materials, food prices generally. So a lot of the input costs have actually come down, energy costs, and hence profitability is gotten better. And we are seeing that in kind of results after results, where if we many companies are giving up results which are better than market expectations, what the market calls earnings surprises. You've seen quite a bit of that happening. Also, the other aspect that we see is that, and I've spoken to you before, is that earnings is also reasonably broad-based. So if I look at the share of the top 10 companies and their share in the total profits of the index or of the market, it has gone down quite dramatically, which shows that there is a broad-based recovery in the corporate sector, and there's a broad-based activity, and the opportunity set is getting broader. This is generally a very, very good sign, especially for our style of investing, when we talk about normalized cycles and value investing. When we see a broad-based recovery in the market, and we are seeing that since the middle of COVID, right, about end 2020, early 2021, we are seeing the broad basing of opportunity, and that has been beneficial. That also reflects in the performance of the value equity strategy that we have. Uh, if I extend that broad basing of the market in terms of market capitalization, of course, the small cap and the mid cap companies continue to have a significant outperformance against large caps. Almost, I think if I look at 1 year returns, it will be closer to about 20% plus outperformance of the small cap, mid cap indices against the Sensex. It's not that those companies are doing dramatically better than the large cap companies from a revenues and earnings and profitability perspective, but it's also a lot of the movement is driven by flows and sentiment and market revaluation. So as many commentators have been saying, that the small cap mid cap are reasonably overvalued, in some case stratospherically overvalued. But the large cap in the large cap space, also the index might look a bit expensive, but as our portfolio characteristics shows, there are still reasonable amount of pocket of opportunities within the growth cycle that we're seeing. So, of course, the outperformance of small cap mid cap has continued, and it's been quite significant to see. Some of it, as I said, is genuine relevant, where the opportunity and the companies are actually doing well at the ground level, but quite a bit of it is also because of flows coming in. If I look at foreign flows, I think it is now tilting towards larger companies, as like if I look at flows into small and mid cap funds from foreign investors or into ETFs, I think that has kind of gone down a bit, and you're seeing reasonably more flow relatively in the large cap space. From a foreign investment perspective, I think uh, they have been net buyers. Over a year period as compared to what their investments were in say 2022. I think that as we've been saying that should continue. Adjusted for valuation, market sentiment, politics, I think we should see India will be a net receiver of foreign capital for many years to come. Uh, I also put out a note on the Quantum Advisors website on why, and our long call that that the Indian GDP growth will grow at 6.5% real GDP, double digit, 11-12% nominal GDP, and how that growth gets reflected in markets. So if you look at long-term market returns, both in INR terms, if you compare Sensex and nominal GDP, and in dollar terms, it has a fairly decent correlation. Might not be year on year, but over a broad period, you will tend to see that the increase in GDP growth gets very clearly reflected in market returns. And we actually put out three broad points. And if you want, you can go on our LinkedIn page, my LinkedIn page, and also on the website to read in detail about it. Is that India is a micro story. It's a story of individuals, businesses, private businesses, and their aspirations and their expectations in a macro backdrop. So it's basically a micro story, and that gets reflected. The Indian economy is reasonably broad based. Like if you break up into agriculture, industry, and services, and that kind of gets reflected in the markets as well. I'll give you a very quick example. Private banks, for example, were non-existent till the mid-90s, right? So they didn't have a big share of the economy, and they didn't have any share in the market capitalization, for example. But today, private banks are a very large part of the economy and gets reflected in the economic GDP services, financial services data, and also has about 300-400 billion dollars of market cap, for example, right? So from almost zero activity in the economy and zero activity in the stock markets in terms of market capitalization, those both, it has got reflected in the economy and it's also reflected in the markets. You will see many such examples as India has opened up in the last 30-40 years and reformed, and private businesses is what drives. You will see that getting reflected in the economic activity as well as in the markets. IT services, for example, is another such a sector example. The other interesting part of India has always been that Indian corporates have been very good in converting this broad nominal economic growth into revenues and profits. Profit cycles could be varied because profitability goes through its own input output prices as well as balance sheet issues. But if I look at broad economic growth and broad revenue growth and broad market returns, it's a fairly good reflection, and I've written a bit more in detail on that. And that is unlikely to change for a few more years. We still believe that India can grow nominal GDP in double digits, and which means that should get reflected in market returns over a long period of time. And that is actually the simple story of investing in India. It's a very simple way to think about what kind of returns can you expect over a period of time based on what is the economic activity, and history supports that argument. From a macro perspective, I think the fall in oil prices and in many other commodity prices should ensure that inflation remains under control. What we call core inflation should be very close to 4%, which will give RBI a lot of comfort to not hike interest rates, but also to ensure that if the economy sort of slows down, they can actually come and support the economy through liquidity and through rate actions. The INR, I think, will continue to remain in a very, very tight band. In fact, there was a data put out last week when I read that the volatility of the INR is now second only to Hong Kong dollar, and the Hong Kong dollar is actually a pegged currency to the US dollar. That is the amount of very little market movement in the INR. So of course it is being controlled by the RBI and this has, of course, flip sides, and it can move both ways. But given that inflation is under control, oil prices are low, and that foreign flows have generally been reasonably robust, we believe that RBI can actually manage the INR USD in a very tight band. From a foreign inflow perspective, also, as I said, in equities, you are seeing some amount of ranged inflows. But the bigger expectation, of course, would be in the bond markets. As you know, India was included in the bond index. And as the less inclusion activity happens, and as other global indices also include India into the bond index, you should see some more foreign flows coming in. We have already seen this year is by far the largest calendar year flows into Indian bond markets since about 2017, if I remember correctly. And I think we should see for the next 1 or 2 years some more activity from global emerging market funds, or even large institutional investors investing into the Indian bond market. And of course, I'll come back and speak to you again next month in December, and we will talk about what do we see for the year ahead for 2024. What should we expect? There are it's a political heavy year for India. You will see state election results come out by the time I speak to you next month, and we will see about how should investors position and think about what lies in ahead in 2024. So thank you so much. I'm looking forward to that.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.